All right, so today we're really going deep, taking a deep dive into Renaissance Technologies.
Oh, fascinating.
A firm that's, well, kind of legendary in the world of finance. They've done things, achieved things that honestly most people wouldn't even believe. And to help us understand, peel back the layers of how they did it,
Right.
we're going to be we'll be referencing The Man Who Solved the Market.
Great boy.
It chronicles the journey of Jim Simons, who, he's kind of the mastermind behind this whole operation. And he had this team of, not your typical Wall Street guys, mathematicians, scientists, people who, it seems, approach the market like a complex puzzle to be solved. Almost like a code to crack, really.
It's true. They were completely different from the Wall Street establishment. They weren't looking for insider information or trying to play the usual games.
Right.
You were looking for patterns, hidden signals, things that, most people wouldn't even know existed.
It's really interesting to me that, from what I've read about Simons, he wasn't like your typical money-hungry Wall Streeter.
Yeah, that's one of the most fascinating things about him. He wasn't driven by, the yachts or the mansions. He was a code breaker, a mathematician.
Right.
Even a floor tile entrepreneur at one point.
That's right. A very diverse background.
So yeah, not your typical finance guy.
Definitely not. And that kind of attitude, that kind of, I guess you could say, philosophy, really shaped the entire culture of Renaissance Technologies.
Oh, absolutely. He specifically sought out people who were, intellectually curious problem solvers.
Right.
People who weren't just in it for the money. In fact, many of his early hires were actually skeptical of capitalism.
It's almost counterintuitive, right? You'd think to be successful in finance, you'd have to be, all about the money.
Right. But Simons believed that the best way to make money was to, almost forget about the money and just focus on solving the problem.
And it worked. I mean, it clearly worked.
It did. And it all started in this very unassuming way. Their first venture, Monometrics, was literally located in a strip mall.
A strip mall. It's hard to imagine this firm that would become, a giant in the industry.
Yeah.
Starting out in such a humble place.
It's a great reminder that sometimes the biggest ideas come from the most unexpected places.
Absolutely. And then there's Lenny Baum, one of the early partners.
Oh, Lenny. Brilliant, but a bit of an eccentric character.
Really?
Oh, yeah. Preferred equations to people. Much more comfortable scribbling on a yellow pad than making small talk.
I can kind of relate to that.
But he had this amazing ability to spot patterns, to find order in chaos.
So even though he wasn't a traditional trader, he had this intuitive sense of how the market worked.
He did. And their early success trading currencies was largely due to his insights.
And there's that great story about how Baum predicted the rise of the British pound.
Oh, right, when everyone else thought it was going to weaken.
Yeah, it seemed like a crazy bet at the time, but it paid off big time.
It did. They trusted their models, their data, even when it went against the conventional wisdom.
That takes guts,
It does. And that kind of boldness, that willingness to challenge the status quo.
Right.
That's really at the heart of their success.
So they were starting to get noticed, starting to make a name for themselves, but were they really turning a profit at this point? I mean, were they?
Well, they had their ups and downs like any investment firm.
Right.
But they were definitely onto something.
Okay, so what happens next? How do they go from, this small but successful operation to really cracking the code of the market? How do they make that leap? So last time we were talking about how Renaissance Technologies started to really make a name for themselves, and they were starting to find some success.
Yeah, they were doing well, but they knew they could do better.
Right. So how did they go from good to, legendary? How did they actually crack the code?
Well, a big part of that was their shift to short-term trading strategies.
Short term. Like, how short are we talking?
We're talking minutes, even seconds.
Wow. That seems, I don't know, kind of risky for a hedge fund, right?
It was a radical departure from the norm, that's for sure.
So what was the thinking behind that? Why did they go that route?
One of the key figures in this shift was Elwin Berlekamp.
Oh, another one of those brilliant minds Simons brought in.
Exactly. Berlekamp was a mathematician, a game theorist.
I'm sensing a pattern here.
He understood that if you have even a small edge, like being right just 51% of the time, you can generate huge profits if you trade frequently enough.
So it's all about volume, making tons of small bets and letting the odds play out in your favor.
That's the basic idea. And this approach fit perfectly with all the tick data they'd been collecting.
Right. All that minute-by-minute price data.
Henry Laufer, who was analyzing all this data, he started to notice these patterns, anomalies, what they called non-random trading effects.
Non-random trading effects. That sounds kind of complicated.
Yeah. It is, but basically it means there were these subtle signals in the market.
Okay.
Little hints that certain price movements were more likely than others.
So they weren't trying to predict, like, which stock was going to go up or down tomorrow?
No. This was much more granular, much more about the short-term fluctuations.
Can you give me an example, like a specific non-random trading effect they discovered?
Sure. One they found was related to trading bands.
Trading bands.
The range of prices a stock trades within.
Okay.
They noticed that the range a stock traded in on Friday mornings often predicted similar ranges later that same afternoon.
So it's almost like the market had a memory, a sense of deja vu.
Exactly, and they could exploit that.
So they're finding these weird patterns, but how do they actually turn that into, profits?
That's where Laufer's betting algorithm comes in.
Oh, yeah. We talked about that a little bit last time.
It was an early form of machine learning that dynamically adjusted the fund's portfolio based on the signals they were uncovering.
So it's like the super sophisticated system that's constantly learning, adapting.
And placing bets, thousands of bets, based on these tiny, almost imperceptible patterns.
So instead of, human intuition, gut feelings, they're creating a machine that can, think for itself.
In a way, yes. And this led to the creation of their legendary Medallion Fund.
Medallion, the holy grail of hedge funds.
Pretty much, yeah. It achieved returns that, most people wouldn't even believe.
Yeah. We'll definitely have to dive into Medallion in more detail another time.
Absolutely. It's a fascinating story.
But for now, I'm curious about the people behind all this, the culture at Renaissance Technologies.
Yeah, it was a pretty unique place.
From what I've read, it was this mix of academic rigor and extreme secrecy.
Very much so. Employees were encouraged to, share ideas, collaborate.
Right.
But any leak to the outside world was, not tolerated.
Makes sense. They were protecting their edge, their secret sauce.
Exactly. And the secrecy created this almost surreal work environment.
Really?
Yeah, there are stories of employees making millions, but having no idea how much the fund was actually making on a daily basis.
Wow.
Some even preferred to fly coach, despite their newfound wealth.
Huh. Interesting. It seems like the focus was really on the intellectual challenge, the puzzle-solving aspect.
It was. For Simons and for many of his employees, it was never really about the money. It was about the pursuit of knowledge, the thrill of the game.
So it sounds like they had this incredible system, this brilliant team, this unique culture.
Yeah, they were really firing on all cylinders.
But was it sustainable? I mean, could this kind of success last forever?
Well, that's a great question, and it's something we'll explore in the final part of our deep dive.
Okay, so stay tuned because things are about to get even more interesting. We've been talking about Renaissance Technologies, this firm that, kind of revolutionized the way people think about the market.
Yeah, they really did. Yeah. Using math and data to basically decode the market, find those hidden patterns.
And their Medallion Fund, it's legendary. The returns they achieved are just mind-boggling.
Yeah, it's hard to believe almost.
But then they tried to, expand that success, create funds for outside investors.
Right, REF and WAREF.
And things didn't go quite as planned, did they?
No, they didn't. Those funds, they just couldn't replicate the incredible performance of Medallion.
So the question is, why? Was the magic, just not scalable?
Well, that's what everyone wanted to know, right?
Yeah.
It works so well on a small scale. Why not just, apply it to a bigger pool of money and watch the profits roll in?
Right. It seems logical.
But the reality is it's not that simple.
So what were the main challenges these larger funds faced?
Well, one factor was definitely size. Medallion was relatively small, nimble, could move in and out of positions quickly, like a speedboat.
Right.
REF and RIF, they were more like massive tankers, just too big, too slow to maneuver in the same way.
So size matters in this case.
It does. In the world of high-frequency trading, speed is everything.
And the types of signals they were exploiting, they were, kind of unique.
Very unique, very subtle, often short-lived.
So that worked for Medallion because they were making, tons of small, quick trades.
Right. In and out, in and out.
But for these larger funds, the transaction costs, the time it took to execute those trades.
Yeah, it just ate into their profits.
It's kind of like trying to, I don't know, use a scalpel to chop down a tree.
Right. The wrong tool for the job.
And I think some investors, they got frustrated, They saw the success of Medallion and they thought, well, I'm going to get a piece of that.
Right. They expected those sky-high returns.
But it didn't quite work out that way.
No, it didn't. Medallion, it created this aura, this myth almost around Renaissance technologies.
Right, like they had actually solved the market.
Which, of course, they hadn't.
No one can really predict the future, right?
Exactly, no matter how sophisticated your system is.
So speaking of their system, I'm still a little fuzzy on how it actually worked.
Sure, it's complicated, but we can break it down a bit.
Okay, so we've talked about non-random trading effects, the betting algorithm, but what were some actual signals, some things they were looking for in the data?
Well, remember, they weren't trying to, pick individual stocks, figure out which company was going to have a good quarter or whatever.
Right.
They were looking for much more subtle patterns, relationships, hidden connections in all that data.
Give me an example.
Okay, one signal they exploited was based on the observation that if markets moved higher late in the day, it often paid to buy futures contracts just before the close and then sell them at the opening the next day.
So it's almost like a little quirk in the market's behavior.
Right, a quirk that they could exploit for profit.
Sounds almost too simple.
I know, but that's the thing. They were finding these tiny, almost insignificant patterns.
That no one else had noticed.
Exactly, or if they had noticed. They didn't think they were significant.
And they weren't afraid to bet on these signals, even if they didn't fully understand why they worked.
As long as the data supported it, that's all that mattered.
Data was king, huh?
Absolutely. And they were obsessed with data quality, making sure it was accurate, clean, organized.
Yeah, we talked about Henry Strauss and his obsession with data.
Oh, yeah. He was meticulous, wanted everything just so.
And that gave them a huge advantage, right?
It did. Because they could see patterns that others just missed, like having a stronger magnifying glass.
Yeah, I get it. And as they incorporated more data, more complex data, like news articles, even social media trends.
Right. They were always looking for new sources of information.
That focus on date quality, it became even more important.
Absolutely. Garbage in, garbage out, as they say.
So it seems like they were, in a way, trying to understand the human element of the market, how emotions, behavior, all that stuff influences trading decisions.
Yeah, they were trying to decode the hidden language of the market, understand how fear, greed, even just, human error creates these patterns that can be exploited.
It's fascinating, but also kind of scary, If algorithms can be this good at predicting markets, what does that mean for the future of finance?
It's a great question. One that a lot of people are grappling with.
Are we all going to become like passive investors, just letting the machines handle everything?
It's possible, but I think human intuition, creativity, that'll always have a role to play.
Well, I hope so.
Me too. But there's no doubt that Renaissance technologies, they really changed the game.
They did. Their story it's a testament to the power of math, data, and just pure human ingenuity.
Absolutely. It shows what's possible when you combine brilliant minds with a relentless pursuit of knowledge.
And it leaves us with a lot to think about, a lot of questions to ponder.
Like what other hidden patterns are out there just waiting to be discovered?
And who will be the ones to crack the code?
Yeah. It's an exciting time to be following these developments.
Absolutely. And on that note, I think we'll wrap up this deep dive.
Great talking with you.
Yeah, always a pleasure. Until next time, happy diving, everyone.